was really interested in what Alan had to say about the size of a fund, and you leaned over to me and you felt very passionate about that. Talk to me a little bit about size and where the sweet spot is for a firm like Marathon.
Well, I think Alan's obviously a brilliant man and does quite well working in a small venture type fund and where he can make $5 million investments. For what we do, size is very critical. We need bankruptcy lawyers, restructuring experts in our firm. We need to be able to work out transactions, whether it's sourcing non-performing loans or working through pools of mortgages to, have them serviced and so forth. You need critical size. You're not going to bid on a $500 million NPL and buy it at 40 cents and write a $200 million check unless you're managing a few $1 billion. You won't have the team to process it. You won't have the capital base to be competitive in the marketplace. So you're either in it in size or you're not, which is okay. Smaller funds can do well in the credit markets, just not in how we travel.
Because you have to have all these awesome people to go and do all that.
We have offices, we're a global investment manager, so it's critical that we have offices in New York and London and Singapore looking at opportunities around the world. It's critical that we have a deep investment staff, so we have industry analysts covering all the various industries, and we have restructuring people so that if an investment goes sideways, we can get out of it at our cost or at a profit and not incur a big loss because you don't have the workout team. Or if you buy a package of non-performing loans, you need to be able to source those loans, underwrite the loans, manage those assets or manage those loans, and you need a lot of restructuring capability, a lot of workout capability, and you just can't do that with a small staff given the breadth of the markets.
So my job as a journalist is to kind of take all these really complex ideas and distill them into something that's going to be really user-friendly that your mother would understand, right? So how I would describe all the things you just said is funky. That's a lot of funky stuff, and it requires a lot of work. I mean, credit evaluating risk is not something you just put a rubber stamp on and say, okay, let's go.
You need specialists. You can't do it with generalists. I agree with that. But it synthesizes down to a single investment or a single opportunity. And so if you're working with a company, for instance, and you're looking at all parts of its capital structure, it's understanding the basics of that company. Its management, its margins, its capital structure, where the capital structure is priced, and where relative value lies within. And if you're an equity investor, you're looking at the equity prism, and if you're a credit investor, you're looking at maybe a component of the credit, but if you're Marathon, you're looking at all parts of the capital structure, saying, where is the greatest value in buying the debt or equity of this company?
That's a perfect segue to the next topic, which is, so where is the value right now? I mean, last year was an amazing year for equities, right? Everybody is sitting here waiting for interest rates to go up. So as an investor right now, where are you seeing opportunities? What are you looking at?
It's a difficult question right now because the markets have had a nice run, right? You do have equities that have run up as much as they've run up as of late, and they're stalling for now, and towards the second half of this year, you're going to be running into some headwinds when the Fed finally ends quantitative easing and begins to, depending upon the data, considering when they're going to start to tighten. And the impact it has on the markets and liquidity, the impact it has on economic growth if and when rates move up. So the equity markets are a little bit more challenged than, I'd say, the green light that it had last year. We're still constructive on equities, and we think they'll move higher over time, but right now, there's a little bit backing and filling and consolidation in the marketplace that we see. On the credit side, the markets have moved towards a category where they're, becoming a little bit more expensive, right? Treasuries should be concerning to one if they're going to invest in duration, and with that, corporate bonds that are high grade are also going to move pretty highly correlated with treasuries. If treasury prices fall, they'll also fall. And so we like to look at the higher yielding assets. And when you look at high yield is relatively low yield these days. It's around 5.5% for the high yield index to 6%. So relatively low yield. And We think there's still opportunity in high yield, but what we like to do is we like to be very special situation focused. We like to find companies that are going through a restructuring, companies that need an extension of their debt, and we can buy their debt at maturity and negotiate with the company to get above market returns. And we like to look around the globe and say, where is the best opportunity? And right now, some of the best opportunities that we see is with what we call less liquid credit. And in your open-ended hedge funds that offer quarterly or yearly liquidity, you can't really, from a risk management discipline standpoint, put liquid securities, illiquid securities in those funds, because you have to be able to match the liquidity you're providing your investors with the type of investing you're doing. So we've run a series of these private equity structure funds, which they have a drawdown structure to it, about a 3-year investment period, followed by about a 3-year harvesting period, generally speaking. And there you can go out and make a little longer term investment. And if you have liquidity as an investor, if you're a pension plan, endowment, foundation, sovereign wealth fund, you don't need liquidity on a quarterly basis or even a yearly basis for a portion of your assets. And you can invest in less liquid assets. You can find opportunities that you can 12, 15% type returns. And that's pretty good, because Fed funds are 0 last time I checked. Treasury 10-year notes are, 2.70, 2.75. 5-year notes are, 1.50, 1.75 type range. And so where are you going to get an 8% return? Because that's the bogey for the world. The world basically needs to make 8%. Whether you're a pension plan, public or private, generally speaking, making 8%. And with inflation running at 1 to 2 and the risk-free rate close to 0, making 8% is not an easy chore. And I think if you can make 8%, that's a pretty good return for the bulk of your capital. And so equities, you made that plus a whole lot more last year. This year, you might be challenged to make 8%. So far, we're up, 50 basis points or percent on the year in the S&P. And so it might be a bit of a challenge. Where are you going to do it in fixed income? You're not going to do it in fixed income. You're not going to do it in treasuries or high-grade corporates or Ginnies, Fannies, or Freddies, or agency debentures. You're going to have to go into the credit markets. In fact, in high yield, you're not going to make 8% because it yields around 5.5 to 6, and that's the perfection with 0 default rates and without rates moving higher. You make 5.5 to 6. So where can you find 10, 12, 15% returns in our world? And there are significant opportunities to be able to accomplish that. And,
Can you give an example?
Sure. A couple examples. So in Europe, for instance, we have a very active team, very active approach to buying NPLs out of the banks. The banks in Europe, are pretty over-leveraged and undercapitalized, and let's just qualify that for a second. The U.S. GDP is around 17 trillion, and our banking system is around 15.5 trillion. That's the total assets sitting in all 7,000 banks, including J.P. Morgan and Bank of America and Wells Fargo. So our banking system is about 1-for-1 with the GDP here in this country. Now let's go to Europe, and you look at the EU. You have 28 countries with an economy of around 18 trillion, so it's about the same size as the US, and its banking system is around 50 trillion. About 3 times the size. You go to the EMU, the monetary union countries, which is 18 countries, that GDP is around 13 trillion. Its banking system is just under 40 trillion, around 39 trillion, about 3 times the size of the GDP. So the banks are over-levered and need to raise more capital, but they're also sitting, according to PricewaterhouseCoopers in their most recent report, on about 1 trillion euro of non-performing loans. 1 trillion. That's about $1.38 trillion of non-performing loans. To put that in perspective, when we had the greatest banking crisis of the 80s, and we formed in this country the RTC at the end of the 80s to work out all the bad loans we had in the banking system, that was around 250 billion. So this is about an order of magnitude 5 to 6 times the size of the greatest NPL disposition program that ever happened in this country a couple decades ago. So one great opportunity for us is buying these NPLs from the banks in Europe. There are about 7 countries of the 28 countries that dominate the asset flow or NPL sales. It's Germany, France, UK, Italy, Ireland, Spain, and the Netherlands. Those 7 countries account for about 90% of the NPLs coming out. So yes, we have on-ground sourcing teams that are knocking on all the doors of the banks and buying these NPLs, and we're paying cents on the dollar. So a loan fully collateralized by income-producing commercial real estate loans, for instance, we just bought a package that'll close in a couple weeks. Ink's just drying right now. 80 industrial and logistics centers in France. Great country to own the loans, secured by real estate that's income producing. And the price that we paid on it, I'm not sure how specific I can be, but somewhere in the 40s. And so when you can buy loans and then that loan is non-performing and take the real estate and have an income relative to your basis of double-digit cap rates or double-digit returns, cash on cash, that's a pretty sweet return.
I'll give you a check after this. I'm happy to
So
invest.
you can't find that in the free world. You can't find that here in the United States. It's happening right now in Europe, and it's happening in size. And we'll work with the borrowers to extend them out, to get that loan to be performing again by renegotiating with them so that a good operator stays in place, or we'll take the property and we'll put our own loan on it by borrowing from the bank and take our money out that way. Or form a REIT for our exit, or later sell it or list it. We just took another portfolio. It was nearly $1 billion, about $1.1 billion, $1.2 billion in dollar terms. It was in euro, but in dollar terms, out of another situation where it's secured by 212 shopping centers, retail, and some logistics centers, distribution centers, but mostly shopping, in the center of towns, 90% plus occupied, right? We bought that also a similar type of dollar price, without being too specific, in Germany. Real estate is like a straight line in Germany. Prices never went up and prices never went down. The fact that you can buy the debt at that kind of dollar price, with those kind of in-place cash flows, is pretty remarkable. So senior loans, secured, cash flowing, because they're not performing today, but they'll be cash flowing when we're done with it, right? Represents one great opportunity. We're involved in a big corporate restructuring right now, where we're leading, it's a REIT that needs to restructure.
In Europe or in the US?
In Europe, in Germany, needs to restructure. We're the lead on the credit side. We're in there with a couple of funds, but we're sitting at the table helping negotiate terms and the restructuring. And that's working out very well. And so there's lots of opportunities in Europe. I put that as kind of front and center as one opportunity, but that's just one of the opportunities. There's also lots of opportunity here in the U.S.
Tell us some more. What's happening here in the U.S.?
What's happening here in the U.S.? So on the corporate side, default rates remain rather low. It's about 1.6%, right? But there's still companies that need to restructure despite that. There is one company in particular that's located in Texas, big energy company, that was a product of a leveraged buyout that has about $40 billion in debt within the capital structure. And so the leveraged buyout was for around $48 billion. Private equity sponsors put in about $8 billion of equity and put about $40 billion in debt. Some of that debt has been PIKing, payment in kind, so it's now more than $40 billion in debt. And the company is great assets, great management, just over-levered, and really is having trouble supporting that capital structure. So we believe in not too distant future there's going to be a restructuring, and we're very, very involved. And so buying the fulcrum, buying the debt part of the capital structure that becomes the new equity is a wonderful opportunity, because when that company goes through a restructuring process, if and when, goes through a restructuring process in the courts, Some of that debt will be eliminated. The equity also will be crammed down, and some of that debt will become the new equity. And if you can buy a company at a big discount towards market competitors are trading in multiples, that's a wonderful thing. One of the better opportunities that we were recently involved in that speaks to that is American Airlines. And I can speak about the name specifically because we've since exited. So American Airlines at the beginning of 2012 was sitting on $4.7 billion in cash. A lot of cash. Had no debt coming due, and they did not breach a covenant. And bang, one day at the beginning of 12, the end of 11, just right around the turn of that calendar, they filed for bankruptcy. So the senior unsecured bonds that were trading close to par plunged. First week we're trading in the 70s and 80s. And then a couple weeks in the 40s and 50s. I think we bought our first $60 million block at, I believe it was around 18 to 20 cents on the dollar. And we built in a nice little position in it, in the hundreds of millions. And our weighted average price was below 25 cents on the dollar. And we looked at that debt and we said, okay, the company's going to go through restructuring. We have our bankruptcy lawyers, our industry analysts, our investment team sitting around the table. And we go, the restructuring is going to look like Delta or United, Air Canada, or JL. Some of these other restructurings where the company's going to renegotiate contracts with the labor. They're going to rationalize their fleet and their routes. On their fleet, reject, because you have a few days, 30 days within bankruptcy to reject the inefficient planes and, old McDonnell Douglas gas guzzlers that are, big maintenance requirements and lease up new fiber bodies that are fuel efficient, Embraer 100-seater or whatever. And so do the same thing in the routes. What routes are good routes and what routes are less profitable routes? Go back and reduce that lease payment or eliminate that route. Right? And so they're rationalizing the corporate structure, restructuring their debt, working with the pensions. At the back end of restructuring, when you work out through the model what the revenues are going to be, how expenses are going to be cut, what the company looks like, we believe we own that debt at a 2.5 multiple. When the S&P was trading at 12, when other airlines were trading around 6, maybe 5.5, 2.5 multiple. So we're looking at 25 cents on our debt, could be worth, 50, 60, 70. Pretty good investment. We think it's a year and a half to realize what we believe is going to be 100% IR, 100% return, or a 2x. We didn't count on the fact that US Air was going to buy it out of bankruptcy and have further cost savings, or that fuel prices would come down a bit, or load factor on the planes, the number of people and the price they pay on the plane, right, would increase. We didn't count on all that. And we ended up exiting our debt something around 120, 140-ish. But if you would have kept that debt to today, when that company's now back in the S&P 500, I believe it's trading at 200, 250. What's one of our biggest mistakes in the last year? Probably selling out too early. But we had a nice, nice return. And there's opportunities, again, to understand these companies inside and out, to play a role where we're in a leadership role, sitting at the table with the restructuring advisors, with the company. We selected, Marathon, my firm selected a couple members were part of the committee to select the board of directors of the combined company at the end. That's how active we were, with the restructuring process.
So beyond the U.S., I know that you're interested in the emerging markets too. Where are you seeing good opportunities there?
Emerging markets, I think it's a slightly more difficult play currently. We look at debt and we say, where's the best dollar of capital that we can allocate globally? We have about 15 dedicated professionals that are emerging market professionals at our firm. And so we look, a company, a media company in Mexico, or energy company in Brazil, or bank in Brazil, and where can we find a good investment that is going to get us our rate of return that we want to get for our clients, we want to achieve for our clients. And so right now we're playing it very close to the vest and not taking much of a position in the emerging markets, because the emerging markets are very challenging right now. But I think that when you look out in the year, maybe towards the end of this year, there's going to be more and more opportunities that percolate in emerging markets. And you're going to be able to buy, I think, at very good valuations. It's just not there yet. So you look at the emerging markets, and the growth rate in the U.S. has accelerated a bit. We're going to grow this year probably around 2.8 to 3.2 GDP. Japan is also growing more than they've grown in the past. And the European Union, Europe has come out of recession and is now growing by about 1% this year. So developed market growth is the most robust it's been in several years, since pre-crisis, while emerging market growth is the slowest growth it's been since 2001. And so the differential between emerging market growth and developed market growth is narrowed considerably as developed market growth has increased and emerging market growth has consolidated. And a lot of money over the last many years has gone into the emerging markets, has recently started to question that. And emerging markets have become trickier because of China, and they're starting to see defaults in that country for the first time. They just recently had a $600 million default. They'll have dozens more in the next year and years to come. State-owned banks, they're sitting on a lot of state-owned company debt that's not going to work out very well. And so you'll see growth in China slow further from where it is today. Venezuela is very tricky because of what's going on there. Venezuela, you say, okay, what's Venezuela? It's one off. But it's 10% of the emerging market bond index. Venezuela, 11 actually.
They have oil too.
But they have oil, which they give away basically free internally, and don't have a lot of friends externally. So they haven't been very efficient with that oil. But they're sitting on very nice resources. It's just that they're losing money on an operating basis at government Inc. And they can't sustain that for that much longer. And so Venezuela is a very difficult place. And if it has to restructure, it's 11% of the emerging market bond index. And Argentina and Turkey and Brazil was just downgraded, and so you're seeing more and more noise in emerging markets. Last May and June and July, you saw a risk off for the markets because what happened in emerging markets. You saw that again at the turn of the year this year. And so I think there will be more episodes of risk off for the emerging markets. And you haven't seen the bottom yet, and there's going to be a better time to buy. So we have dry powder there. We're not putting a lot to work there in emerging markets, but at the appropriate time, when good companies in really good countries are thrown out by investors, like you throw out the baby with the bathwater in that analogy, right? We're going to be there to scoop up those helpless babies.
Oh, you heard it here first, folks. Bruce Richards is going to help babies. Talk to me about your.
By the way, we have a charity that we're very much involved with called Our Baby.
I actually knew that.
And it is to do exactly that. It's for pediatric care and newborn infant care, because there are 30,000 deaths in this country of infants that are less than a year and a half of age, and so we've done a lot of work on that front to help local hospitals in the New York area and fund their pediatric emergency wards. So it's literally the truth.
He's humble, but he was actually just recognized by the hedge fund community for the work he does in that area.
Thank you.
So thank you for that. The CLO market, I know it's something you're really passionate about too. And tell me what's going on in that area right now and why you think it's interesting.
Well, CLOs, I think the AAA tranche of a CLO is the cheapest AAA asset that's really a quality asset that you can buy. It's priced around 155 off of LIBOR for a AAA. And through the crisis, unlike the subprime market and the structured mortgage market and commercial real estate market, you never saw a AAA in CLOs actually get downgraded.
Why?
Because the structure is much more stable, and the corporate loan market are senior loans that had significantly higher recovery rates and significantly lower default rates than what you saw in the mortgage market and the commercial real estate market. But you never saw a AAA even get downgraded, let alone lose $1 of principal. And so I believe the AAAs are actually pretty attractively priced off of a CLO structure. And we can get term financing for a transaction. At the other end of the spectrum, being able to buy CLO equity also attractively priced. And the reason why it's attractively priced, I think, is because the loans themselves are still attractively priced. To be able to buy senior loans and receive a 5.5 to 6% cash flow. You can do that in high yield with a fixed rate bond, or you can do that in a leveraged loan market and not have the duration risk, and be in a senior loan, which traditionally has a much higher recovery rate when there's a default. And so I think our ability and others that do what we do to underwrite these senior loans and to invest in the loan market will continue to present opportunity for investors, and it is appropriately priced.
Okay, so we talked about the opportunities, but let's talk a little bit about the risks. I mean, who knows what's happening today in Ukraine, China slowing down, all the interest rates rising here in the U.S. Where are the risks right now? What are the things that you're keeping an eye on?
There's a whole laundry list of risks that we look at, and right now the biggest risk is idiosyncratic risk. It's not systemic risk. Back in the crisis in 07 and 08, here in the U.S. and in Europe in 2010 through 2012, it was systemic risk. It was what happens if countries leave the euro, or what happens if after Greece defaults, Ireland, Portugal, Spain, Italy default, or what happens if our banking system here in the U.S. fell off the cliff, or the Fed didn't come to the rescue like they did, and the Great Recession turned into a Great Depression. We had these systemic risk issues that overrode any idiosyncratic investment decision. Now the systemic risk is put to the side for the most part, right? We're not worried about the U.S. banking system collapsing, the U.S. real estate market collapsing, the economy going into a Great Recession where GDP contracts by 6% and leads to the Great Recession. We're not worried about that here in the U.S. at all. And we're not worried about Europe. We're not worried about Greece defaulting. They have no debt coming due for 10 years. In fact, in the EMU or the EU, it'll be the fastest growing economy according to the World Bank next year.
Greece.
Its GDP is going to grow at 3.5% GDP. Now, it's off of a 25% decline, so it's off of a low base, unlike Germany, which is at its peak GDP and growing by 1.5%, projected to grow next year. But Greece is going to default. Ireland and Portugal paying back their packages, and so their credit spreads are trading very tight. Spain and Italy are also improving credits, and their credit spreads are back down. So the sovereign crisis is behind us. Sovereigns have all these issues, no doubt, but the crisis itself for a funding crisis is behind us. The banking crisis is behind us. Banks can fund themselves again, thanks to LTRO1 and LTRO2 and the ECB and a little bit of time that helped them work through the problems. And now they're doing things to clean up their balance sheet, get rid of the bad assets off their balance sheet, and get their capital base up to be able to comply with Basel III and all the capital raises that you see in Europe by the banks. And the euro, it would be a disaster if countries pulled out of the euro, right? But no country pulled out of the euro. So the crisis is behind us, and so I don't see the systemic risk in the system. And I think it's back to general market risks. So that's the number one risk, is idiosyncratic risk. Is the investment you buy, did you make the right investment decision? Did you underwrite it correctly? Is there new information in that company or that asset that you bought that would cause you to make money or lose money? That's the number one risk for us. But when you talk about the macro risks, there are a few. Number one, and there's four that I just mentioned very briefly. Number one, it's the Russia situation, how fluid that is. Are they going to stop at Crimea, or are they going to go beyond Crimea, within Ukraine, or are they going to take over other territories that border? And what is Putin really in this for? And Putin made the comment, the greatest tragedy of the last century, 20th century, was not World War II or World War I. He didn't reference them. The greatest tragedy was the fall of the Iron Curtain. That's what he believes. And so it's all about economic power. U.S. is a $17 trillion economy. Europe, the EMU, is $13 trillion. The EU is $18 trillion. And China is $9 trillion. Germany is a $3 trillion economy. By itself, it doesn't have that much power. But since it's the biggest voice within the EMU, a $13 trillion trading bloc with one currency, it has a very loud voice. Russia doesn't have much of a voice on global economics, which is power these days. And so how can they get more people, more territory, greater GDP? I'm not sure if that's what he's thinking, but I just hope it stops at Crimea, but it could go further. And we'll have to see, it's very fluid, how that works out. So that's one risk. Second risk would be what happens here in the U.S. Was the economic slowdown that we saw weather-induced these last few months, which I think it was, or was it not weather-induced? Is this going to be a slower economy than what people think? So that's an economic. And what does that mean for first quarter earnings that we're going to start seeing in a few weeks? So the second part of the economic or the risk in here in the United States is the Fed, right? So just real quick wrapping up. The Fed, number one, when will they start to tighten? That date. How much will they tighten by? And how quickly will they make this move? Right? In terms of, is it the tightening over 3 years or 2 years? Or is it 1 year? And so if economy grows at 3%, inflation gets back to 2%, which I believe it will because wages are going to start to push it towards 2%. Where are they going to take Fed funds? That being Yellen. Where is Fed funds going to? Is he going to 3 or 4? Is he going to 1 or 2? I bet on the lower part of that based upon her recent testimony. And so the market's going to start recalibrating that a bit. And the 6-month time frame means they end quantitative easing in October, which means they can possibly go next April. So next April, but it's completely data dependent, to next October is probably a time frame that you should be working with when you see your first Fed increase. But interest rates moving up through Fed taking out liquidity from the system will affect the markets when liquidity leaves the system and when rates start to move up. And the question is, does it have any economic impact? Will they be raising rates and that raise in rates slow the economy, or are we in escape velocity, as they like to say, and the economy is cruising along and that increase in rates doesn't do anything to cause the economic activity to turn down. So I believe they'll go very, very slowly, very methodically, and lower than what one might expect traditionally when they finally make this move. But there's certainly a risk if they move faster and higher, because data requires that. And finally, just real quick, the emerging markets is a risk factor. And it starts with China, but it's many different parts of the emerging markets that I think one has to keep an eye on. Because when the markets go risk off for emerging markets, you just want to be aware of that. And it's an opportunity to buy when it does.